The major theme that we're expecting for the second half of 2019 is something which we call in Japan Naibu Henka, which means internal change. And the genesis of this is that we think that companies in Asia, specifically those in Japan and to a certain extent those in China, have got internal measures they can take to deliver value for shareholders. Now, I guess the story we've seen in the first half of the year has been the US market has dominated performance. It's been the strongest performing market globally, and that's been driven by share buyback activity. We know that share buyback activity has been funded by strong balance sheets, but also by borrowing in the US, and that's driven up earnings per share. Now, in the case of Japan and China, both of those markets have seen lots of cash balances on companies, which means that these companies can actually start repatriating some of that cash back to shareholders via buybacks. Now, in Japan specifically, a lot of Japanese companies have been under-leveraged in the past. There is now a lot of pressure on these companies, driven by Abenomics partly, but also driven by domestic shareholders. A lot of domestic Japanese shareholders are getting more agitated about companies with lazy balance sheets. They are now talking to companies, often behind closed doors. They're appearing at the AGM season in Japan at the end of June and challenging management to actually have capital allocated more efficiently. And that, we think, will drive returns in the second half of this year. So Japan we do like, and in particular valuations are quite unassuming for Japanese companies. We're seeing something like 12 times PE multiples for Japanese companies. In the US, it's 18 times earnings, and yet what we're seeing is earnings growth for the US is only 3%, earnings growth for Japan is 1%, but of course if Japanese companies buy back shares, that stimulates the EPS number, so we could actually see earnings upgrades in Japan. Now, in the case of China, it's a market which we also like, and it will dominate APAC over the coming years as MSCI continuously reallocates weighting to the Chinese market. So what we will see is more and more overseas money coming into China, and again that will do something to stimulate the market. Now, specifically in the case of China, we have been quite surprised at how resilient earnings for Chinese companies have been during February of this year and also during the Q1 reporting season. We think again that Chinese companies are complying with Western type behavior when it comes to capital allocation policies, and again that is something which we think will stimulate the market going through to the second half of this year. So the big theme for us during the second half of this year is a rotation out of US equity markets into markets in Asia, which have got better valuation metrics and of course more shareholder return coming through.